Hi class, this video is going to run through income statements, which comprises chapter 11 of your textbook, which is quite a small chapter, pages 219 to pages 227. And before we go through learning intentions and all the content of this video, I want you to have a think. Hopefully, for all of you that have done year 11, and even some of you who have done just year 12 but have seen it, hopefully you have seen an income statement before. So, what is an income statement and why do we need one? Have a think, pause this video, and try and think about and reflect on everything that you can remember about income statements. Now that you're back in the video, hopefully some things have started to come back. Hopefully you remember that an income statement is an important report, one of the 3 reports that we make in year 12 accounting, and it reports profit. So what are our learning intentions for this video and this chapter? I want us to be able to have left this video being able to explain the purpose of an income statement. We need to understand the format of an income statement, and we need to be able to distinguish between a few potentially new terms: cost of sales, cost of goods sold, they are not new, but gross profit and adjusted gross profit and even net profit. So you're going to learn that there is actually more than one type of profit. And after this chapter, after you've done all the textbook exercises and really worked hard with your summary notes, you can leave if you can say that I can prepare an income statement from both closing general journal entries and a trial balance. And also you're starting to be able to evaluate profit using some benchmarks. So looking at income statements and being that accountant that can say what is good, what is bad, and what might be some advice to your business owners. So let's start. The first, and some would say maybe the most important bit before we move on to the reports, is understanding what is profit. What is profit? Profit is revenues minus expenses. So we're talking about 2 of our 5 elements, revenue and expenses. And hopefully by now we've become really good at identifying which of our ledger accounts, which parts of our business actually comprise of revenue and expenses. But remember, it's actually not as simple as you might think. In fact, for revenue and expenses, for it to be counted as revenue or expense, we must tick off 3 criteria. For something to be revenue, it must be an inflow of an economic benefit. That is an increase in assets. That also leads to an increase in owner's equity. So 3 things that need to be touched on. And you could argue there's a 4th one because capital contribution is never revenue. So let's go through 2 examples, one that is revenue and one that is not revenue. Sales, we know, are revenue. Sales are when we sell goods and services for either cash or on credit. This represents an inflow of economic benefit because we've got the benefit of either cash or the promise to pay cash. We've got an increase in assets because we have either more cash or more accounts receivable. And if we think through our accounting equation, there has been no impact to any other elements, so it has increased the worth of our business and increased owner's equity. It has ticked off all 3 things, so we know that sales are revenue. However, if we have, for example, purchased a new asset, so let's say we've spent cash to purchase a building, we do have an inflow of economic benefit because we have a new building, but you would argue that we don't have an increase in assets, even though we've got a new building, which is an asset, because we've paid cash. We've just changed our assets around. There has then hence been no increase in owner's equity because it's just been the increase in one asset and decrease in another asset that has balanced our accounting equation. So you're going to need to be thinking through each of these transactions if you're not totally sure which one it is. Expenses, and we're not going to go through the same type of examples, but there are 3 categories called criteria that need to be ticked off for it to be an expense. It's only an expense if there is an outflow of economic benefit, a decrease in assets, and a decrease in owner's equity. And it can't be drawings. So you'll never see drawings or capital contributions in our income statement. So if you're asked at any stage during this chapter, explain your classification of this item and you believe it's revenue, you're going to be touching on these 3 dot points. Same if it's an expense. So a good time to pause the video and update your notes. But that's not why you're here. You're here to try and understand income statements. So what is an income statement? We need to understand, just once we've done chapter 10, we really have already determined profit. Once revenue and expense accounts are closed off to the P&L summary account, the profit or loss of the period has been determined. However, this information should be presented in an income statement. It is the income statement that is the report that provides all the information about our profit or loss potentially and our revenue and expenses. Why do we go to all this trouble to make an income statement when we've already determined profit? Hopefully this next slide will give you some ideas. How is profit reported? We could report it like the general journal entries here, and this is for Spark's surfboard. So you can see we've closed off all our revenue and expense accounts and worked out our profit. And if you go all the way down to the bottom, you'll see that we have a $25,000 profit. We could also report our profit in an income statement like this. It's a different business, so we can't compare profit, but which one is easier to understand? You can see that the Chef Master, all the way down to the bottom, we've got $100,000 of profit, and it might be easier to work out why. So why do we make an income statement? Because it's important for a number of our qualitative characteristics and accounting assumptions. And the one that's highlighted here is understandability. We need to be able to create reports that make the financial information easily understood, and income statements help us with that. What are some other characteristics and assumptions that are important? In fact, lots of them are, but 4 that are especially important. The accrual basis assumption. We must record revenue when earned and expenses when they're incurred. So this will involve us matching revenues and expenses that incurred in the same period. We need to make sure that we do our income statements using the period assumption. So the activity should be reported for a particular period of time and profit should reflect when this transaction occurred. We need to make sure our income statements are relevant, and that means all the information will help users in decision making. And our income statement gives us valuable information to make decisions. And we need to faithfully represent, so we need to make sure all of the revenue when earned and expenses when incurred is faithfully represented in our reports. So, they are some important rules. It might be a good time to pause the video if you're watching it and to update your note to at least get an understanding. But let's get into the nitty-gritty of what an income statement looks like. Let's take a closer look. This is an income statement. What do you notice? Hopefully you notice that we have calculated net profit of $100,000, and that's down the very bottom. And you'll see that we have listed all the revenues, and we've got a number of different types. Cash sales, credit sales. We also have something called other revenue, being interest revenue. But you can probably also see we have lots of different expenses, and we've put them in different parts of our income statement, and we've actually reported 3 different types of profit: gross profit, adjusted gross profit, and net profit. So it's clear that for us to make a really good income statement, we need to follow this same format. Hence, we need to know what these different types of profits are, why they're important, and what goes under each section. So income statements should show the following information. We should always show the net sales. And what is net sales? sales minus sales returns. Remember, we split out sales returns from sales. So you can see this is at the very top of our income statement. We have revenue of $270,000. That is our net sales. We don't have any sales returns here. We also must report the gross profit. Gross profit is the net sales, in this case $270,000, minus the cost of goods sold. What was cost of goods sold here? $140,000, comprising cost of sales, cartage, inward, and buying expenses. So we have gross profit of $130,000. What does this show us? This shows us how much profit we made from our sales when we take into account all our direct selling expenses. We also must show our adjusted gross profit. And you can see that our adjusted gross profit is $2,000 less than gross profit because it is gross profit minus inventory loss or plus inventory gain. In this case, we have an inventory loss, an expense. This reduces profit because profit is revenue minus expenses. So we've identified that. So this is where all our prior learning, such as inventory losses and gains, ends up in a report. Finally, we're going to report net profit, which is after that, we're going to think about all the other revenue, interest revenue here, and less all the other expenses. In this case, 4 of them adding up to $29,000, and we report our net profit. This is the final result of deducting all our expenses from all of our revenue. So that is our format. Let's run through it a little bit slower, and then you'll be ready to make your first income statements for Year 12. So what is the format of our income statement? We always start with revenue, and we will always list the sales first. There will most often be 2 of them, cash and credit, and then we will sum them up. And you can see here we've got 3 columns. That's pretty typical. There might also be 2 columns. The format is if we have more numbers to add up before we get to a total, we put them in the left column, and then the totals end up in the right column. So we add up both of our sales, and then we less sales returns because that is something that is an expense or a negative revenue. So we now have $302,000 of revenue, and we now need to less our cost of goods sold. This includes our costs of sales and cartage inward in this case, so we add them up, and then we take all this away from our revenue to determine gross profit. $302,000 minus $142,000 gives us our gross profit of $160,000. And then we're going to either say less inventory loss if we have an inventory loss, or plus inventory gain if there is an inventory gain. This creates our adjusted gross profit. Just as a reminder, what do we mean by cost of goods sold? This is an expense within the income statement. It includes the cost of sales, which we will be given. Remember, this is the cost of actually our inventory, plus any other expenses incurred to get in the inventory into the business and onto the shelves ready for sale. So into the condition and location ready for sale. Remember chapter 9. What could this include? Costs of goods sold could include cost of sales, but then it could include any of these things. Cartage in, customs duty, buying expenses. And remember, you might also see some words such as out, such as cartage out or freight out. These are not reported under costs of goods sold. These are in fact other expenses because they have nothing to do with getting the inventory into the business, but it is about getting it out of the business. So that's quite complicated. I think as you do examples, it will become clearer. So after we've got to adjusted gross profit, guys, we then are going to plus any other revenue. This could be interest revenue. It could also be discount revenue, which we will learn at later dates. And this, because it's revenue, will increase our profit again. But you see that we don't have a heading here called another type of profit, but we will just total it up. And then we'll less all our other expenses that don't have anything to do with our cost of goods sold, such as rent, wages, advertising, insurance, freight out, cartage out, to then add them up, and then and only then do we get to net profit. So this will be something that you will need to practice and get comfortable with this template, because this is the template that you'll always follow. Why do we do this? Because then we can evaluate it. And once we've completed our income statement, management and us as accountants should always stop and look at the income statement and say, is it good, is it bad? The benefit of this income statement is that we can evaluate various profit figures, net, gross, and adjusted, to determine how a business is going. We can evaluate profit looking at the trend, comparing it against our budget, looking at industry averages, and maybe also looking at financial indicators, which we'll learn about later. What is the benefit of having 3 types of profit? If we're not happy with our income statement, we can start to look at which section of our income statement are we not happy with. If we have a good gross profit, but not a good net profit, that means we probably have too many other expenses. Are we paying our customers too much? Are we paying our employees too much? Is our rent too expensive? If our gross profit isn't great, we might say, well, maybe our markup is too low and we're selling it for not enough money. So this is why we have lots of different profits, and we will become expert in analysing these. There are other uses of the income statement too. It aids decision making about our operations. We can assess the firm's performance against meeting its sales and expense targets. It allows us to plan, because we know that profit will increase our business worth, so we might look at our profit figure when thinking about should we expand or buy new assets. And it allows us to calculate indicators. And guys, a relatively long video. Hopefully the revenue and expense part isn't new, but this template has been more complicated than previous years, and it's now time to start to practice. I want you to reflect. Have we been able to achieve our learning intentions and success criteria? And now it's time to start practicing. And a good one to practice before you go to the textbook exercises is this one, trial balance. Can you identify the revenue and expense accounts from here, which should be no different to chapter 10, and prepare an income statement? So determine profit and put it into the format that would be the perfect format for an easily understandable income statement. If you can do this and do your textbook exercises, you will be an expert at income statements and have almost mastered one of the 3 major reports in Year 12 accounting. Well done, and keep working hard.